is here's the CME Clearport brochure. Let's look at this. So, okay, let's return to our topic, OTC versus exchange traded markets. Okay, so we discussed the OTC markets and how they work. Okay, different banks in different centers. Okay, so we had this diagram, the set of clocks, and we just assume that Sydney is trading with LA. Okay, and so these banks we just assume, instead of saying Westpac Sydney and Wells Fargo LA, we just call the bank Sydney and LA. They're dealing with each other. So if either bank, so obviously when you remember that every financial market is a venue for exchanging assets. Remember all our basic definitions, how you see all these basic definitions come in handy even in advanced topics. Okay, since a financial market is a venue for exchanging assets, every transaction is a financial market is a, what did we say? How did we define a transaction? Is a contract to exchange assets. Okay. And then you have that brings you to the idea of the settlement date, when the actual exchange of assets takes place and you discharge the contract. So when you're studying, you're actually linking contract law and the terms from contract law, okay, and then with the finance aspect. Okay, so the law and the finance aspect should be always interwoven whenever possible. So here you have the contract to exchange assets. So they have this contract, but if one of the parties, let's say LA, defaults, okay, and the Sydney has already sent the payment. Okay, they were selling dollars, so they've already sold the dollar payment. But in the morning, something happens to the LA bank, and the US controller of the currency closes. I mean, basically puts that bank into receivership, and all payments stop. So then the bank in Sydney is in trouble. Okay, because they don't receive their money. So so this is basically what we call a manifestation of credit risk. Okay, that a party does not pay whatever amount is due from it under the terms of the contract. So one party has honored the contract, but the other party has not discharged its obligations under the contract, right? Is this clear? We saw that in the previous case. So now we were looking at, so we were trying to understand, so you have this, okay, I'll try to put this also. There is actually in this 15-minute, one of the things we are going to discuss when we discuss capital markets, okay, you heard of this company called DoorDash? It's a food delivery company in the US, okay? So one of the things we are going to discuss, I'm going to put this here, it's in the 15-minute, it starts from 15 minutes, okay? There is a discussion of, yeah, let's take that down. Some of this we may not, I may just leave out some of these topics. Okay, so we'll just put this here. Today's date is what? Today is 21/11, and this is the new course IFM. Okay, we'll copy this later into a different file for you. Okay, so let me just put this in. You can watch it from the 15-minute segment onwards. Okay, so okay, so that's your clue. So you'll see here IPO versus direct listing. You know the difference? Okay, so
that they have money in the bank and that he was in no hurry to really spend it all.
Okay, so we're not going to listen to this, but you listen to it on your own for 15 minutes, the 15-minute segment onwards. So one of the things we are going to discuss is one of the things we will discuss is, when we cover capital markets, IPO versus direct listing. Okay, essentially a direct listing is basically one where you don't issue any new shares. You just list the shares which you've already issued to your private capital market holders, okay, the equity shareholders in the private capital market. So there's a story that you can connect to in the real world. Okay, so let's go back to, so what were we discussing? So I can now close this tab, that's why I looked at it. Okay, we have to do this. So this folder, this spreadsheet is also in your folder. Okay, so you can actually look at it, and then so everything is written down here. Basically, just try to understand. Don't try to memorize stuff. Try to understand this. So we were trying to understand this point actually, that when you trade in OTC markets, the counterparty credit risk, what we just discussed in terms of a bank in LA not paying its obligations under the contract, but the Sydney bank has paid its obligations. So the Sydney bank has experienced a manifestation of credit risk. So this is the meaning of this statement. That its counterparty credit risk is managed directly by the counterparties themselves. Okay, and the risk is higher. We'll come to that. When you understand the ETM, you'll understand why the risk in ETM is lower, and in OTC the risk is higher. Okay, so is this point clear to everyone? That what we explained in terms of the transaction where the LA bank does not pay its obligations under the contract, and this is what we mean by. So basically the bank in Sydney has nowhere to go. It has to just eat the loss. They'll sue the bank in court, but that takes a long time. Okay, but essentially they have to eat the loss. All right, so this is what it means, that the credit risk is managed by the counterparties themselves. This is clear. This is the meaning of the statement. So now we say in the ETM we say that, so we are distinguishing on this point, how is counterparty credit risk managed. Okay, so that's the point of distinction. In OTC it's managed by the parties themselves, whoever deals with each other. I mean, all the banks who were dealing with Lehman Brothers, they had outstanding contracts when Lehman Brothers went bankrupt. All those guys were on the hook. Okay, they had to eat the loss, because then they sued Lehman, and then the receiver comes in and tries to make a payment, eventually makes distributions. Takes a long time. So, and then we are saying that in the case of ETM, it is managed by the exchange. Okay, so how is that done? The way it's done is basically by through what we call the exchange clearing house. So if we go back now to this, because of that table we had to. We'll just keep it at 90%, at least. Yeah, we can see a little bit. All right. Okay, so let's go back to this. No, these are the actual dates. Okay. Yeah. Here. So we go back to this. Now CME clearing, this is actually the clearing house. So please note there are also notes. These are all there. We also have readings from Hull for this topic. So make sure you read that also. But those readings, actually first try to understand what I'm telling you. Those readings are a little bit confusing because he has already started talking about OTC markets as they exist today. So the distinction today is a lot less clear. Okay, because of regulatory interventions. So first you try to understand the way I'm explaining it to you without reading the textbook. Okay, understand the differences, because these are the pure differences which have existed for hundreds of years. Okay, and now since the 2008 credit crisis, a little bit was happening before that. The differences are getting a little bit blurred. But in the Hull book, they have not actually given you the classical differences first in a pure form, so that it's a little more difficult to understand, I think. Okay, so in an exchange, what is happening is, if you have this, say this is the OTC dealer, okay, on the exchange traded format, this is not so you ignore this guy, okay, and you ignore these two people for the moment. Okay, they're relevant, but we'll just ignore them for the moment. Okay, so what we have on the exchange is, when these two parties are dealing on an exchange, as we already discussed this in detail in the previous course, right? So I'm not going to repeat that. I'm just quickly recapping that. So now what you have earlier in the OTC segment, if you just ignore this lower part for now, in the OTC markets, these two parties are dealing directly with each other, so there's only one contract. There's only one contract. Okay, so the Sydney bank is selling dollars to the LA bank and receiving yen. Okay, now we can make it receiving Swiss francs or something. Okay, so now the Sydney bank is selling dollar, and there's only one contract. Okay, so now let's say in the exchange traded market situation, what's going to happen is, how is the credit risk going to be different? We have already explained this in detail in the previous video. So now there are going to be two contracts. Okay, so this guy has a contract with the exchange clearing house. So in every exchange there's going to be a affiliated clearing house. Okay, under Indian law every exchange needs to have its own clearing house. In the US you can have an exchange which is affiliated to a clearing house, but there has to be a clearing house connection for every exchange. Okay, so this is the clearing house is the one that takes care of the risk management. So you have two contracts, and these guys, anybody who loses money every night, every day there is a settlement of profit and loss. So whoever loses money, the exchange will calculate how much money you've lost from the beginning of your trade to the closing of that day. Whatever money you've lost on a mark-to-market basis, next morning by about 10, 11 o'clock, whatever time, early morning, you have to pay up that loss, otherwise the exchange will close out your contract. And the other feature of this, you'll find all this written in the Hull book as well, initial margin and all that. So this money that you have to put up initially, you have to put up this amount called the initial margin. If you don't put up initial margin, you are not allowed to do a trade on the exchange. Okay, the amount of initial margin will vary from contract to contract, okay, and exchange to exchange, but there is going to be always some amount of money. So the objective of this, try to understand the scheme here. The reason the clearing house collects the initial margin is that in case, like suppose these guys have lost money after the first day of trading, okay, and next morning they have not paid up by the deadline. Okay, so the exchange has to close out their position in the market, okay, and honor the contract with the other party, right? So when the exchange closes out the contract in the market, in most cases they'll be losing money. Okay, it's because this guy was losing money, right, and that's why he's not paying most of the time. Okay, so the exchange will lose money, but they will use the initial margin to adjust against that loss. This is clear? Okay, I've already taken a deposit from you, and then you default on your obligations. So because of that, I have to close out the contract. But in closing out the contract, I experience some loss. But I'm not too worried about that, because usually that loss will be much smaller than the amount of money I've taken from you in deposit. And because you have forfeited because you did not honor your obligations, the terms of the contract is that you will forfeit your deposit. Okay, so therefore usually I'll have some extra left over also. So I'm not worried about having to close out the contract in the market. Is everyone clear? We've already discussed this in the previous video, the last video of the last course, of the previous course. Okay, so this is how the exchange manages counterparty risk. Okay, so this kind of risk is called counterparty credit risk. That's why you notice that I've used this term here, counterparty credit risk. Okay, so that's why before we got into exchange traded markets and OTC markets, I had to teach you about the different categories of risk. Okay, so because what we have is basically, now we are going to make a distinction between market risk and credit risk. Okay, so after this point is covered, has everyone understood this point? Yeah. That in ETM, you have the exchange clearing house manages the risks. So the other guy basically has very little risk. This guy, although this fellow has defaulted, this guy is still seeing that the clearing house is honoring the contract with him. So he doesn't have a counterparty credit risk problem. Unlike in the OTC case, when as soon as this guy defaults, this fellow is on the hook. He's alone. I mean, he has no one to help him. Okay. So unlike that OTC situation, here he doesn't have a concern. So we essentially say that in an ETM situation, there is no credit risk. Okay, because so far no clearing houses, at least in India and the US, no clearing house has ever gone bankrupt. Okay, clearing houses have always worked out. So therefore, we can effectively say that there is no credit risk. Okay, but what is common to both these markets? So one of the things we are saying is, the reason we had to come up with a taxonomy of risks before getting to this topic is you need to understand the difference between market risk and credit risk. Okay, so is everyone clear about that? Credit risk is the risk that the counterparty will not honor its obligations under the contract, and market risk is just the fact that here, like if you have this here, so if I buy euros, okay, at 74.8, I buy euros, and they by lunchtime this market has already fallen to maybe 109 or something like that, right? So I'm losing money. Yes. So this is market risk. Market risk is just the risk that whatever you trade in the market, that trade will end up losing money. That's just market risk. Okay. So market risk and credit risk are different concepts. Okay. So therefore, one of the things we can say about the ETM versus OTC differences is that in ETM you have only market risk and no credit risk for all practical purposes. Technically, of course, if the clearinghouse defaults, then you will have a problem if the clearinghouse goes bankrupt. But so far it has not happened. Just like in India, for instance, most people would consider a bank, fixed deposit in a bank to be especially in a public sector bank, will consider it to be effectively free of credit risk. Although technically it is credit risk, because if Bank of Baroda goes, Punjab National Bank is bankrupt, all the public sector banks are actually bankrupt several times over, because every budget we put money into that. But that's the proof. Basically, for all practical purposes, if you put money into even a shady public sector bank, there is no real credit risk, because the government will not, make the depositors lose money, okay, on that deposit. So, although technically there is a risk,
Re-established.
let it be there. Okay, so is this clear? So there also we say that for all practical purposes, there is no credit risk if you put money in a fixed deposit with a public sector bank in India. Okay, so similarly we say, so therefore what we say is that in the case of ETM, we have no credit risk, but we still have market risk. Okay, so if I buy, let's say here, like you're seeing this here, you see all these crude oil, these are crude oil actually, these are crude oil futures quotes. Okay, you can see this. Now if I buy crude oil, okay, here, they haven't given bid offers here, the last is the last traded price. So I buy the January 2020 contract in crude oil, 56.88. This is on the CME, which is an exchange. Okay, this is on the NYMEX division of the CME. You can see here, this site is very informative. You can learn a lot. Okay, a lot of information in terms of futures contracts, all kinds of different different kinds of commodity markets. Okay, and the three commodity markets we are going to be studying for our project are all very important global commodities: copper, crude oil, and gold. Okay, so if you develop expertise in any of these commodities later on, if you're angling to be an equity analyst, you have to remember that you have to develop a sector specialization. So one of the sector specializations is oil and gas. Okay, so if you're becoming an equity analyst, I would say your approach should be even more ambitious. So you just specialize in oil and gas, and you look at you take a global view. Okay, to start with, you look at US companies and Indian companies. Okay, and you just eat up everything in oil and gas, all the companies, and then you start looking at them both from the perspective of an equity analyst and a credit analyst. That is even more ambitious. I think that should be your ambition. So then you're flexible. You can go in as a credit analyst, or you can go in as an equity analyst. Okay. So fundamental difference. You understand the difference between equity analyst perspectives and credit analyst perspectives? Yes. What is the difference? Okay, so you will not find this in any book, but let me just tell you here broadly the difference between equity analysts and credit analysts, okay, is that this is actually fairly important, so we can write it in your notes itself. We are discussing as we are going here. Okay, so equity okay, I'm writing it this way, but actually it should be, and then I can write credit analyst. Everybody knows what credit analyst is? All these credit rating agencies, you're analyzing the bond credit risk. Okay, okay. So equity analyst versus credit analyst. So when you're looking at companies, you should always try to, that should be your ambitious goal, because usually most people who are equity analysts, they don't have a very good insight into the credit aspect of it. But actually, it's very easy to develop two-pronged expertise, because you're still looking at the same financials. Both these guys have to look at the same financials. Okay, when you're doing a credit analysis for a company, you have to look at their financial statements inside out. You have to understand the business inside out. Okay, and the same thing goes for an equity analyst. Okay, but there are some slides. So there are quite a bit of there's quite a bit of commonality in terms of the subject matter that you have to study. Okay, and the kind of skill set you need. The only difference is here the focus is on. I'm just writing it in like this in sign language. Long-term equity is basically, you want to understand one word, it's earnings. Okay, or you can make it even better, because people sometimes focus on earnings per share, but earnings per share can be manipulated, because you can manipulate the number of shares through buybacks and things like that. So I personally prefer to look at return on equity. Okay, certain other people like Buffett and all, they look at book value per share. Again, I don't like the per share concept. You can just look at total book value also, but it's even better, I feel, is just look at return on equity. Okay, in terms of you can look at net profits or whatever, but the point is basically earnings. Okay, main thing about equities is long-term earnings potential. So when an equity analyst, so that's why you see companies like Tesla and all, Uber and all, which are not making money, but they're still doing well. The share price is doing well. Why? Because the investors are not so understand these basic differences. Okay, you'll not really find this in any book, so better understand it properly. So the perspective on why is a company like Tesla, which has actually now been doing quite well in the last couple of weeks, why Tesla is not making money? Uber is not making money. They're huge losses actually. Lyft is also making huge losses. Why are the share prices going up? Because the share price, the stock investors are, as you saw in your models which you did, like the Gordon growth model, etc. Stock investors are interested in long-term earnings potential. So Tesla is doing well because people think that, wow, the market for electric cars is huge and Tesla has a dominant position, so there's going to be a huge explosion now they recently got their Shanghai factory going. Okay, so that's why. So they're not concerned about the fact that Tesla has no chance of making money in the next year, probably, let's say. Okay, although they're saying that maybe they'll come to profit sometime soon, but it's not, because it's not really worked out for them. They're not being able to show a profit. They've said several times. So Uber also has no chance of making money in the next 1 or 2 years. Okay, moving into profit. Okay, so why is Uber's stock price going up? Okay, people are buying, hedge funds are piling into Uber. So it's all based on long-term earnings potential. Remember, when you use a Gordon growth model, you just replace dividends with earnings, because it's the same thing. At the end, if you're not paid any dividends, you'll pay a dividend in the end. Okay, so it's all your earnings have been accumulated and you pay a dividend in the end. Okay, so the thing is, it's all based on the perception of long-term earnings potential. In the long run, Tesla will make a lot of money. In the long run, Uber will make a lot of money. Okay, so there has to be some. So you remember those terms? You had these multiple terms, right? When you're doing your Gordon growth model, etc., you don't have just one term, right? For the next year, you have multiple terms going into infinity, right? Remember that? Okay. So the stock has no maturity. So you have multiple terms going into infinity. So in terms of that kind of equation, okay, or any other stock valuation, if you just discount earnings by cost of equity, etc., you will have the same kind of concept. There are multiple terms because the stock has no maturity. So what is happening essentially is that that investors are not so worried about the fact that in the first few terms you're not making money. The first few terms are loss making. It's like, you understand, you've done your NPV analysis. Okay. Now, if you have a project with a high positive NPV, even though in the first 3 years it does not make money, would you reject the project? No, it does not. You will still accept it? It's the same concept. You understand that? Okay. So basically, people are looking at a high NPV based on their projections for future earnings. So people are saying, okay, Tesla first 2 years, from now onwards, they won't make money, but from the 3rd year onward, Tesla is going to move into profits, and then the profits will grow dramatically. Do you understand how that can create a high NPV situation, which is the same thing that you're getting a high value for the share? Because your later terms, they have very high numbers in the numerator. Do you understand that? Are you following what I'm saying? That in the later terms, the numbers in the numerator are very high. In the first few terms, the numbers in the numerator are negative. You can see how that can still create a positive NPV. Yes, everybody's following. So that is the main idea behind equity analyst perspectives. The perspectives are different. Okay. Same company, same financial statements, same industry analysis, same sector analysis. Okay. Business strategy analysis, everything is the same, but the perspective is different. The equity analyst is concerned with long-term earnings potential, so to some extent their analysis then tends to go into some other areas. Okay, but the credit analyst is basically here, his focus is short-term. So you understand the difference between earnings and cash flow? You can have high earnings with very limited cash flow. If I do a lot of sales, but those sales are all credit sales, I can book some of the earnings, right? And I can show high earnings, but my cash flow is not good. Yes? You can have high earnings with poor cash flow. Okay, so there's a difference in earnings and cash flow. This is why I say that financial statement analysis is very important. So all those ratios and stuff, all that should be at your fingertips. You should be doing this, practicing it, and it only come with practice. That's why I told you to select a few companies, okay, and then eat those companies alive every day. Basically, just chew on everything that comes out on that company. Okay, everything should be consumed. Okay, and then you'll understand and keep on doing financial statement analysis, see how their ratios are moving. Okay, understand the industry. So you understand the difference now? Can you see the difference? Are you able to see that there's a difference in perspective? Okay. Focus already I've written, okay? Perspective is a much bigger word, okay? So the credit analyst focuses on short-term cash flow. You understand the difference between cash flow and earnings? But now you should understand clearly, okay? Cash flow and earnings. Whereas the equity analyst is concerned with long-term earnings potential, and the credit analyst is concerned with short-term cash flow, and essentially basically leading to solvency, essentially. Ability to pay debts as they come due. Okay, this is basically what we define as solvency. Okay, not to pay debts after rescheduling payments and all that. Be able to pay your debts as they come due. That's what we call, solvency. Okay, so this is what this whole credit rating business is all about. When you get a high rating like AAA, then essentially what we are saying is that this company there's a high probability that companies like Procter & Gamble and things like that, where they have very very strong cash flows. Okay, Unilever, Procter & Gamble, ITC. Then we say that these companies, when they have a AAA rating, we'll say that they are. The probability that this company will be able to pay its debt as it comes due is very high. That's why you have a AAA rating. Okay, you have a very bad rating like a CCC or something like that, then what we are saying is the probability that this company will be able to pay its debts as they come due is very low. Okay, and then you have rating upgrades and all that. Okay, so we'll have so I'll give you the link to the different credit. You should have that access to that table. Okay, you don't have to memorize it. You should just file it away somewhere, know where to pick it up, because you'll get confused whether it's AAA. That Moody's, there are 3 major credit rating agencies. Okay, and so there you have to know which company's system is being used. Okay, so sometimes so it's like capital letters, small letters. We'll see that. It's just syntax. You don't have to memorize it. You should just know that there are different grades. Okay. All right. Is everyone clear about this? This is a very important thing to understand. Okay. But that's why I'm telling you that you should actually be ambitious, and you should follow a few companies. Take 3 Indian companies, take 3 big global US companies. Okay, these companies are so dominant that actually now they're saying, just recently, in the same Bloomberg program, I was just listening to it in the morning, that Microsoft and Apple combined now, their market cap is higher than all the energy companies in the US. And then they're higher than all the 2,000 small cap companies. Because the market cap is coming like 2.5 trillion or something like that. The combined market cap of Apple and Microsoft. Okay, so so this basically, why did I get into market cap? I don't know the discussion. Anyway, so the point is, I was talking about the reason I got into Apple and Microsoft is the big global companies and how dominant they are. And by studying these big global companies like Amazon and things like that, Amazon has so many major lines of business. You have e-commerce, then you have AWS, okay, different kinds of sectors, industry sectors. So it's a fascinating company to study. Okay, so if you take 2-3 global companies, okay, big global companies and 2-3 Indian companies, and then, as I said, eat up everything that comes out about that company, all the financials, all the news, all the coverage, all the market, the analysts' earnings calls. Okay, remember the earnings calls. You can find the reports. You can just go to the company website and find the reports. So if you do that, depth is much more important than breadth. Okay, I've always felt, and one of the problems I had even with the IMA program, I actually told my professor, and he agreed with it towards the end, that even in IMA, the program, there's too much breadth and too little depth. Okay, I feel that depth is much more important, because if we can teach you to take 6 companies and just do eat up everything that comes out on that company, everything that exists. Okay, that kind of training, that process that you go through to do that is much more That process, then you can repeat that process with other companies. Okay, so learning to do in-depth analysis is much more important than knowing a little bit about lots of things. Okay, so depth is all. This is my personal bias, that depth is more important than breadth. So that's why you should do that. So you have to put in enough effort, because now in this day and age you have so many resources available to you. Okay, so there's no excuse for not devouring everything that is coming out on the companies that you're following. Okay, so yeah, okay, so the first point that we made was in ETM you have market risk, you have in both cases, but the difference is that in ETM you don't have credit risk, okay, for all practical purposes. In OTC you have both market risk and credit risk, and so the point we are saying is credit risk is managed by the exchange clearinghouse, and because clearinghouses are very highly rated, basically very solvent, because of the way they manage their own credit risk by taking deposits, okay, by taking an initial margin, so they're very unlikely to go bankrupt. So all practical purposes, no credit risk. Okay, so we already discussed this point. And so this other important point that I wanted to mention, so that you can see here that there is a lot of commonality, same financial statements, all that. So make sure this should be your goal. Okay, understand the two perspectives, because this kind of differentiation you will never see discussed in any textbook, that what is the difference in focus between these two companies. These are important roles that you might be interviewing for. Okay, so at least certainly you probably will be interviewing for credit analyst, so you should understand the difference. Okay, all right, so the next point is here. So we have to understand the second point about the OTC versus ETM. This should actually be frozen. Why have I kept yeah, I can delete this row.
Data connection lost.
Okay, so the second important point that we're going to understand is standardized contracts. I think we started on this a little bit. Standardized contract terms versus customized. So first we understand what the difference. What we are saying is that standardized. You have in ETM you will have standardized contract terms, and in OTC you will have customized contract terms. Okay, you have the freedom to set your contract terms, and you can see. It's getting a little irritating, this guy's voice. We'll have to switch it off somewhere. I'll have to figure it out, but I don't want to waste time on that right now. Okay, now understand why you have everything is connected, how everything is connected. Why do you have customized contract terms in OTC markets? Because remember, in OTC markets you don't have this blue part. Okay, you just have these two guys, okay, dealing with each other. So remember, I think when I was teaching you contract law, I taught you something called freedom of contract. You remember that expression? Freedom of contract. Very important term, freedom of contract.
Market data connection re-established.
I've forgotten where this setting. I'll have to go to set. Let him keep talking. Why? That means the. Okay. So let me just write this expression, freedom of contract. Very important term. Okay. Especially for people in India, you should understand, because this is one of the main reasons that our country is not achieving its economic potential. Freedom of contract. Freedom of contract is a very important principle in market-based economies. Okay, so this is one of the ways you distinguish between the extent to which the government is interfering with freedom of contract. Okay, so freedom of contract essentially means that two parties are, when they are contracting, adults. Okay, because minors are not allowed to contract. I mean, we don't enforce contracts against minors except in some special cases like provision of necessities and stuff. But adults, essentially consenting adults. When we have contracts, okay, two people enter into a contract, whatever they want to enter into, the government should not be interfering. The principle of freedom of contract is this, okay, that if I have entered into a contract with Burma that we are betting on the price movement of the Nikkei index, and we enter into a contract where if the Nikkei goes up, I will pay him the difference from whatever profit is made from the starting point, and if the Nikkei goes down, then he will pay me. Okay, so this is a contract between two adults. Okay, now the government should not be interfering in this and saying that no, you can't enter into this kind of contract, this is speculative. Okay, but which is what the Indian government does. Basically, it goes into every corner of the financial markets and tries to clamp down on speculation. So one of the things you'll notice about countries that are developed, okay, economically developed countries, which is mainly the Western countries, most of them, okay, you'll find that there is an element of Western culture, okay, which is especially the Anglo-Saxon culture, okay, that basically encourages, discourages the government from interfering in freedom of contract. Okay, so that's one of the reasons why these economies have prospered, because that's what that's what fosters innovation. Okay, freedom of contract also fosters innovation. Okay, so basically this allows more and also encourages economic activity, okay, because if we do this, there will be some allied ancillary industries will crop up, okay, so there's all kinds of benefits. The government, and there's no real benefit from government interfering in freedom of contract. So this is one of the things that separates these socialistic kind of countries, okay, like India, from the other well-developed countries like the US, where there's a general sentiment that the government should not interfere in freedom of contract, okay, which tends to foster innovation as well. So freedom of contract, understand why, so this is a very important expression actually, that you should understand what is freedom of contract. So if you remember from contract law, the contract is made, there has to be consensus ad idem. The parties have to understand the same thing in the same way. Meeting of minds, okay? So there's a meeting of minds, so that is also connected to freedom of contract. We negotiate between ourselves, like what is happening now in the US-China trade negotiations. They are going back and forth. The Chinese are saying, okay, you will lower the tariffs. The US are saying, no, we are not going to lower the tariffs. So you have all this back and forth negotiation. Finally, when they agree on the terms, they will sign a contract. Okay, they will sign an agreement. Okay, so that's the idea behind freedom. That is also connected to freedom, because no one else is. It's not like the Japanese are coming in and telling the US, no, you can't agree to this term, because the Japanese are not concerned here. Okay, this is between the US and the Chinese. So only those two parties are involved in the contract. Okay, in the negotiation. So those two parties, they come to their they negotiate between themselves. When they agree on the terms, they sign the contract. So they are free to sign whatever kind of deal they want. Okay, so that's why you have customization of contracts, because in the OTC markets, there's no other party involved. Okay, so the two parties who are playing in that, the two parties who are entering into the contract, they are free to negotiate between themselves. Okay, so if I go and if I want to enter into somebody into a contract saying that I'm going to go and give that person piano lessons 3 times a week, and that person has to pay me X amount of money every month. Okay, so the government is not coming in and telling me no, if somebody is giving piano lessons, he has to at least give 5 lessons a week, and all these kind of interventions in the terms of the contract. The terms are set by the two parties. Okay, so that's why you have customization in OTC markets, because there are only two parties involved, and they are free to set the terms between themselves. This is clear? Okay, you understand the scheme now? So all of this is connected. So whenever there's a connection to contract law or any other aspect of law, you should be able to appreciate that, so that you can see always appreciate the multidisciplinary element of all kinds of real life situations. Okay, so one thing you get, what does it mean to have customization? Let's look at okay, now here you see, now net Tanya here, you can see here the spot prices. Let's look at forwards. Okay, now you don't yet know what a forward contract is, but you can see, can you guys see here that there are different maturities? Can you see that there are different maturities? These are forward prices. Actually, these are swap differences, okay, of forward points, which hopefully we'll have time to discuss later. But you can see all the different markets here in the rows. For each market, you can see, now what is the difference between this and this? Now you'll see this even in the case of futures. So one of the differences you'll see between spot on the one hand, and futures and forwards on the other hand, one of the first superficial kind of differences. These are spot prices. These are spot FX prices, actually Bitcoin. Okay, so these are, but by and large, these are spot FX prices. Okay, you can see here, there's only one price. Okay, bid and ask. You can see that. You don't have to read the prices, but can you see that? I'm not very. Can you see that, guys? Okay. Puneet, can you see?
Which row do you want?
Sorry, not Puneet, Pulkit.
Yes, sir.
Can you see the prices? You can see the names of the markets here, okay, and you see the bid and offer prices, but there's only one price basically. You notice that what I'm trying to highlight here is there's only one price. If you take the average of the bid and ask and take the mid price, okay, that's called the mid price. The average of the bid and ask in the markets is called the mid price, okay. So if you look at the mid price, there's only one price for each market, right? Now notice the difference, because these are spot prices. In the spot markets, there's only one market, one price, because there's only one delivery that we are talking about. Usually 2 business days from the transaction date. The settlement date will be 2 business days from the transaction date, okay. Now, here what do you notice? Take any given market, let's say take cable. Is there only one price? There are multiple prices, okay. So this is the thing about forwards and futures, okay, because forwards and futures, they could be for any given maturity, okay. So usually here you have some standardized, because this is a quotation board, they can't keep quoting for all kinds of different methods. They have taken certain standard maturities. So they've taken 1 week, again we take the mid prices, 1 week, 1 month, 3 months, 6 months, 1 year, okay. So they've quoted these prices. Everyone can see this? Are you noticing? So one of the differences you can see between spot on the one hand and forwards and futures is that straight away you can see for forward prices, whenever you're looking at forward prices, so if you say show me the cable forwards, okay, then you will expect to be shown different prices for different maturities, okay. If you ask a broker or somebody, show me the cable forwards or show me the dollar yen forwards, you would expect that he would show you more than one price, each price for a different maturity, okay. So you can see this, okay. So this is the first thing. Notice this also about futures. Here I called out the oil futures prices. You can't read it, but you can see that there are different prices. Yeah, can you see that? This masthead is too big. Why is this masthead not going away? Okay, all right, okay. Can you see now that there are different prices? These are oil futures, okay? Just the last traded price. Can you see that there are different prices for different maturities? Although there are oil futures, it's not just one price. Is it one price? Right? Is it one price? What is happening? Now I'll have to deduct marks for Tanya and Parul.
Market data connection
So
lost.
she should ask me. Huh?
But actually, you just said that forward mark for different maturity. Same
Market data connection re-established.
Okay, fine. I'll just. But don't talk to each other. Okay. Huh? Mark should be deducted. Yes. Okay. Because you're talking. No. But then what happens is that. Okay, fine. 1 second. But in future, don't talk. If you don't understand something, don't ask your neighbor. You put up your hand and ask me the question. Okay? Okay, be quiet now, guys. So the other thing that I was trying to show you is in the case of futures also, if you ask a broker, show me the futures run for crude oil, West Texas crude oil, you would expect that he will show you multiple prices. Each price, can you notice that the prices are different? For different, just focus on this column, last. Can you see that I don't know if you can read the prices at the back. Mehak, can you read the prices? You can't read the prices? Column last, 56.88, 56.74. You can't read it? Not big enough? The font is not big enough? Okay. Alright, okay. So, but anyway, let's show you something. Let's try and make it a little bigger. Again, then masthead will come back. Now can you read? You can see the prices. So you see the prices are different and they are for different maturities. Jan 2020, Feb 20, there's a Jan contract, Feb contract, March contract, April, May, June, July, August. You can see all the prices are different. Yes. So one of the first superficial differences you notice between spot on the one hand, okay, a spot, a price value cash or a price value spot, and on the other hand, futures and forwards, is that futures and forwards, and you saw this in options also. Option prices are also for different maturities. Okay. So here also you see in the case of futures and forwards, the first superficial thing you notice is that there's not just one price usually. There's multiple prices. Okay. If you ask for a specific maturity, if you ask for show me the May 2020 futures, then he'll show you only 55, right? But otherwise, if you show me a futures one, then he will show you the entire table. Okay, and all prices are traded for many maturities. You can see almost going out 5 years, 6 years. You'll see prices going out for that far ahead. Okay, so you can see here like this one right now. If you look at 1 year forward, there is no trading right now. Maybe this maturity, but you can see December 2020 is traded. If you want to buy oil for December 2020, the price is 53.24. Okay, and it's different from if you want to buy oil for Jan 2020, it's 56.87. Okay, so there's quite a bit of difference. Okay, so is this clear to everyone? The first thing we notice. Okay, so what are we saying? What was the top point that we were discussing? Customization is what we were discussing.
Yes.
Okay, yeah. Okay, now I know why I came to this. Okay, let's look at the forward prices once again. So the customization, remember, because in OTC, you've got only two parties, so they are free to negotiate the terms of the contract. Okay, freedom of contract. Then what will happen? Let's say you have a US company like ICI PLC, okay, which wants to say sell cable, let's say 6 months forward. Okay, 6 months forward means you're already familiar with settlement dates and transaction dates, which means transaction date will be today. Okay, they are looking to sell cable. Okay, so what are they looking to buy?
So what is the?
If they are looking to sell cable, what are they looking to buy? US dollars. Why GBP? If they are selling cable, when we say selling cable, we say selling dollar yen, we are always talking about the base asset in a market. So in the cable market, the base asset is sterling. So if they are selling cable, they are looking to buy dollars. Okay. So for whatever reason, maybe they have some payments to make in the US. Okay. They have to buy dollars 6 months forward. But in the market, generally, when you trade in terms of the base asset. Okay, you would prefer to trade in terms of the base asset. So one of the ways in which you have customization in OTC markets is, say ICI PLC wants to sell, but they don't actually want to sell for 6 months forward. What they need is maybe 6 months and say 14 days. Because they have to make a payment on a certain date to a US supplier, let's say. Okay, so they're going to be selling cable and buying US dollars. Okay, selling sterling, buying cable. If you sell cable, you sell sterling and you buy US dollars. So they have to make a payment which is going to be basically from today. They think that the rate today is very good. They like the rate today, so they want to lock in the price today. Okay, so the transaction date will be today, but the payment doesn't have to be made until 6 months and 14 days in the future. Okay, 6 months and 14 days from spot. So it's actually 16 days, 6 months and 16 days from today. Okay, so because from today to 2 months will be the spot maturity. Okay, sorry, today to 2 days, business days, 2 business days will be spot maturity. So when you look at forward maturities, you count them from out of spot in addition to spot. So suppose now ICI PLC has to make this payment, okay, of a US dollar amount to a US supplier, and the payment has to be made about 6 months, 6.5 months from now. Okay, so what they can do, this is the beauty of OTC markets. Okay, so let's say they go to Barclays London, they can go to Barclays London and say that I want to show me a cable price for a forward cable price for whatever that date is they will quote. Okay, 6 months and 14 days from now, whatever that date is, they will quote that date. Let's say it's May 25th or something like that. Okay, 25th of May 2020. So show me a cable price for value 25th May 2020. Okay, is this clear? They will say, so that's what we call in the markets, we call an odd date, because it's neither 6 months nor 7 months. It's a broken date or an odd date. We call this a broken date or an odd date. Okay, so but this is the beauty of OTC markets, because two parties are making up the terms of the contract. They are free to negotiate, okay, whatever terms they want. So in the OTC markets, you can actually go and request this kind of thing, especially if you're a corporate customer. Okay, but even interbank, you can between two banks also you can ask for this kind of price. Okay, so Barclays London in this case is the market maker. So Barclays, let's just take the 6 month price, although we are taking a price for 6 months and 14 days. So Barclays London will quote this 66.86, 69.1. Okay, they will quote this forward points price to ICI PLC, which is a corporate customer. Okay, so one of the first things you notice, first thing that is non-standard is the customer has chosen a non-standard maturity date. They have not taken a round maturity date of 6 months. They have taken an odd maturity date or broken date of 6 months and 14 days. But that's allowed in the OTC markets. That's one of the reasons why people use OTC markets, right? So the first flexibility you have is you can request any maturity that you want, okay? So another thing, understand, forwards are an OTC product. Futures are, although there is a commonality in the case of both forwards and futures, you see multiple prices for different maturities. But there is one difference, one important difference. Futures are an exchange traded product. Okay, this is there in your notes itself. If you see under ETM, you see futures as an example, and in your OTC you see forwards as an example. So if somebody asks you to differentiate between forward contracts and OTC and futures contracts, one simple way in terms of the logic in your mind is you straight away you understand that futures are ETM and forwards are OTC. Okay, so obviously when you talk to somebody, you don't say ETM and OTC, you say exchange traded markets and OTC markets, but I don't want to keep saying these big words every time, so I'm just using these shortcuts. Okay, so ETM, futures are ETM, so straight away you know, and all the differences that apply to ETM versus OTC, all of those will apply to futures contracts versus forward contracts. This is clear? Are you clear? Okay, so if we say that, say, Verma is a BBA student, and so therefore he has to have all the characteristics of BBA students, and if we say Ritesh is a MCA student, then he has to have all the characteristics of MCA students. Okay, so one of the ways, if you want to say distinguish between the two of them, one of the way you can distinguish is straight away, just look up all the properties of MCA students and he will have those properties, and all the characteristics of BBA students, he will have to have those properties. This is clear? This is the logic that you should follow. Futures are ETM, forwards are OTC products. Okay, so because forwards are OTC products, and we know that in the OTC markets, one of the advantages that you have is customized contract terms. Okay, so now you can see in a real life example what is meant by customization. So you have a corporate customer, ICI PLC, a very big chemical company, wants to make a payment to a US vendor, and that payment is going to happen around 6.5 months from now. So they request a maturity date. They call up Barclays London for a price,
Trading connection lost.
but they request a maturity date which is an odd date. It is not a rounded 6 months, because the interbank market is trading in 1 week, 1 month, 3 months, 6 months, rounded monthly amount. Because the interbank players trade with each other, the market makers are trading with each other, okay, in large amounts, in rounded amounts, okay, usually $1 million multiples, okay, and trading for standard maturities, okay. But here comes a corporate customer, and this is the beauty of the OTC markets. They can actually come and request a market maker like Barclays London, show me a price for 6.5 months for cable. They will not usually show their side, okay. They will not showing their side means they're telling you whether I want to sell or buy, okay. So they'll just say that show me a price for cable for 6.5 months for this value date, okay, 6.5 months, whatever the value date is, show me a cable forward price for this value date.
Trading connection.
First element of customization, maturity date has been made non-standard, okay. Second is, in the interbank markets, you usually trade in round amounts, just like you see US equity options, and this is an exchange traded market product, US equity options which you were trading. Those are standardized, okay. Those are actually 100 shares per contract, okay. Similarly, in the interbank market, although it's OTC, the convention between big market makers when they're trading with themselves is rounded amounts in $1 million, okay. So people actually in the interbank markets, when they say I'm selling $7, doesn't mean they're actually selling $7 like 1, 2, 3, 4, 5, 7, but they're actually selling $7 million. Okay, so the million is not mentioned because that is understood to be the trading unit. Okay, so here again, ICI PLC can say that, let's say whatever the rate is, the final rate, which will be a function of the spot, and yeah.
So, sir, you mean to say that in OTC market they actually can buy 7.14 contract also?
Yeah, that's what I'm coming to. Okay, so that is the beauty of the OTC markets. Now let's say that the dollar amount, because actually they want to buy a certain dollar amount. Okay, and let's say that the sterling equivalent of that dollar amount. Okay, so they're asking for a price in the base asset itself. Okay, so the sterling equivalent of that dollar amount, let's say, would be 7 million sterling. Okay, let's say they actually need to sell, not 7 million, let's take an odd amount. Say it is, let's say 6,375,000 sterling. Okay, let's say the dollar amount that they need to pay to the US supplier if you look at the approximate market rates today, the amount of sterling that they need to sell to buy that amount of dollars is 6,375,000, okay, and 14 sterling. You can make it as odd as you want, okay. So here's the point as Tarun brought out. Second element of customization, you can see that the customer can also request a price for an odd amount, okay, odd lot basically. So here you don't even say odd lot, because here understood that in OTC markets there is no concept of odd lot. There is of course interbank concept, you can say, you can use it. We don't normally use that term, we just say a non-standard amount, okay, because the odd lot is used in an exchange traded context, exchange traded market context. Yeah.
It can be the number of contracts.
No, you don't say contracts in the number of contracts, you don't use in the OTC context. OTC context, you just talk about amount. You just say what is the amount, okay? You don't talk about contract size, because there is no contract size as such. The convention that is there between market players and say foreign exchange to trade in $1 million multiples, that's just a convention. We don't call it a contract size.
So like you said, in US equity market, you can only deal in multiples of 100.
Yes.
You can have 100 contracts or only. So in OTC market, we can also buy 105 contracts.
Yeah. We don't use the word contracts. In a OTC market, because the contract size concept does not exist in OTC markets. So the example that I gave you, where foreign exchange market makers usually trade between themselves in $1 million multiples, okay, integer multiples of $1 million. But that's just a convention. It's not sufficiently formal to be called a contract size. Are you following what I'm saying? That is just a convention. Even in between interbank market makers, sometimes a market maker, say Citi, Hong Kong, can call Barclays London and ask for a price in 3.758 billion yen. They can do that. Okay, so it's not and it's not considered anything unusual. Okay, so this.
What is the term that we use for OTC?
OTC, you just say amount or size. Amount is better, okay? So amount of the base asset or amount of the terms asset. Second element of so are you following the elements of customization? Let's write it down in this so that we can 2 minutes left. 1 minute. Be quiet. Second element of customization is you can play with the amount. There's no fixed amount. Okay. So first element of customization, I'll write it down later. So what we are saying, first element of customization, you can play with the maturity date. Maturity date of the contract you can play with. Unlike futures contracts where you have fixed maturities, Jan 2020, you can't go anywhere in between. You have to choose whatever contract you choose, you're stuck. The maturity is tightly defined. You have to stick to maturity. Everything is standardized. Okay. In OTC, you can play with the maturity date. You can play with the amount. Okay. So you can take a very odd amount, all kinds of broken figures you can take, and you can deal that amount, and it's considered normal in OTC markets. Third element of customization also is that you can deal in the terms currency. Normally when we deal in markets, we talk about dealing when I want to sell 100 cable. If I want to sell 100 cable, if I call a market maker and say I want to sell 100 cable, he will understand that I'm looking to sell 100 million sterling, because it is understood that all amount references are to base asset. But here ICI PLC can even call Barclays London and say, show me a cable forward price for 6.5 months forward, okay, in amount of $6 million. $6 million may not convert to a rounded sterling amount. So you have already tampered with the standard sterling amount, and you are also now asking for the amount in terms currency. You are not giving the amount, which is the convention is to give the amount in their base currency. You have now also played with that, and you can give the amount in terms currency also. So three elements of customization are possible, okay, which brings out the distinction comes out clearly in the foreign exchange markets where both are currencies, okay. So you can ask for a price in the terms currency, which is normally considered unconventional. You can ask for odd maturity dates, and you can ask for odd amounts, not rounded amounts. Clear? Three elements of customization. Okay. You can also build in all kinds of other contractual flexibility and negotiation up and down here, this and that. Those are specialized contracts. But for basic contracts, now Garvit is happy.
Yes.
We can. Yeah. Okay. All right. So we'll continue in the next class. So please remember that your project is closing
Yes, sir, tomorrow.
tomorrow. Friday is the last day of trading tomorrow. Yes? Trading whenever New York closes. Whenever New York closes, that's your end date. And you have to submit the report by Monday.